Good afternoon and welcome to this Asian Midday Market Watch. It's Friday, the 6th of September, and I'm Samantha Voon. So let's start by taking a look at the summary of market actions today. Now, Asian stocks traded in narrow ranges today, and the dollar struggled to recover as investors anxiously wait the US job data that could influence the timing and scale of upcoming rate cuts in the world's largest economy. Now, Japan's Nikkei dipped 0.43%, extending its weekly loss to 5.6%. Now, in China, stock markets open on a mixed note, while Hong Kong's Hang Seng remains unchanged. Now, the caution in Asian market had ripple effect on the US stock futures, with Nasdaq futures down 0.41% and the S&P futures slipping 0.1%. Now, much of the market's focus is now on the US non-farm roll report, as the Fed Chair Jerome Powell did hint that policymakers want to avoid further weakening in the labor market. All eyes are on this data, as it should set the stage for a possible rate cut in September. Now, to give insights into market, we have Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, welcome to the show.
Hi, good to see you again, and happy Friday, Samantha.
Yes, always good to see you. All right, so we had a bunch of data released yesterday. We had the ISM manufacturing and services PMI, as well as the ADP job data released. So could you share with us what's the current state of the US stock market at the moment?
Yeah, sure. Plus, if before we jump into this current state of the US stock market, so just have a quick recap what's going on in terms of the narrative. So at this point in time, latest economic data is indicating inflationary condition in the US is more on the deceleration mode. That means, i.e., the Fed has really give a very clear guidance of a shift to a dovish stance from higher for longer interest rate to ready to actually cut rates potentially in this month FOMC meeting. So now the next thing market are pretty much concerned over here is, will the Fed at this juncture be late in the game of enacting its interest rate cut cycle? That means, i.e., is the economy, US economy as per se, slip into a recession? Because that is very important. Because if you look at the past 30 years of data, if the US economy is already in a recession and the Fed starts to cut rate, that means they are late in the game. On the average, it doesn't gel well for the performance of the US stock market using the S&P as a benchmark in the next 3, 6 months, and 1 year after the first interest rate cut by the Fed. So now, market participants will be very scrutinizing instead of inflation data. They will be focusing more on growth-related data in the US and as the rest of the world. So for US, if you look at this week, we do have a rather weak ISM manufacturing PMI data that actually created a negative feedback loop in the US stock market. And on top of that, yesterday we have the ADP data. So ADP data is slightly different for NFP because ADP is compiled by the private organization, but that also show a kind of a lackluster state of, or is a sluggish state of US labor market condition at this juncture. So if you look at yesterday's ADP employment change that was being compiled by a private organization, the number of businesses in US only added 99k jobs in the month of August. So that's the lowest absolute number of jobs added since January 2021, and way below a downward revised figure of 111k in July, and way below market forecast of 145k. So what it actually seems to imply to us that perhaps there's this increased odds of US slipping into a recession at this juncture, given the softness of this ADP employment change data. But for sure, it could be potentially reinforced by the NFP data that's out later. So that actually explained to us at this moment in time, the day-to-week performance of the US stock market has been pretty much on the downside, with the Dow Jones, the Russell 2000, the Nasdaq 100, and the SPX 500 all declining, ranging between -3% to -2% as per se. Yeah.
Mhm. So how about the currency market? Can you
Yeah,
share what's been happening
sure,
there?
sure. So if you look at this date in time, that means, i.e., if the US has really slipped into a recession, that means what it represents to us is that the Fed is late in the game. And in order to address this softness that could be seen in the next few months down the road, the Fed may be forced to actually ignite more deeper interest rate cuts instead. That means you traditionally they will go by 25 basis point per meeting, or pause in the meeting, then they follow through for 25 basis point. So instead of doing 25 basis point, they may be forced to enact 50 basis point cut. So that could actually potentially reduce the yield premium of US Treasury against other sovereign bond yield, and that could be potentially detrimental to the US dollar. And that actually has been played out since the start of this week, where potentially we also start to see a bearish technical element that has emerged on Tuesday in the dollar index and has a negative follow through throughout Wednesday and as well as yesterday. So if we start to see another, we call it slew of weak economic data, that means today will be the non-farm payroll data being lackluster, it could potentially see further dollar downside. And at this point in time, the particular currency that is kind of showing the most severe dollar downside is the dollar yen. That means we talk about yen strength coming back into the picture again.
Mhm, mhm. So, what are we looking at in the NFP data? What do we have to see to
Sure.
determine what's going to happen?
Yeah, because there are actually two things that we got to take note of for today's NFP data. For sure, NFP data is the headline numbers, will be the number of job added per month. So based on what market is expecting for this time around for the month of August is rather optimistic. So they're looking at around 160K jobs added versus 114K jobs added for the month of July. So if the number starts to disappoint market expectation, like what it did on the ADP jobs data for yesterday, that could actually be pretty much of we call it a state of sluggishness in the US job market. And another number to look at over here is the unemployment rate. Okay, so the unemployment rate over here is that we really hit a kind of a alarming level of 4.3% in the previous month of July. So that 4.3% in the previous month of July is the highest level since October 2021. And given its steep increase in the last 3 months to 4.3% in July for the unemployment rate, that actually precedes prior recessionary period in the US based on past data. So market this time around is expecting a slight dip to 4.2%. Okay, so but if it doesn't come with market expectation and it maintain at 4.3% or even worse at 4.5%, that could actually potentially increase the odds of a recessionary period that's really been in fact in play in the US economy, and that could also trigger a negative feedback loop for risk assets. That means, i.e., we may start to see further potential downside in the major US stock indices, and conversely also further dollar strength weakness as well, as the Fed is being forced to actually ignite a much more deeper interest rate cut going forward.
Okay, thank you so much for your insight, Kelvin. It's always so good to have your insight.
My pleasure.
So this has been BizTech Asian Midday Market Watch. Be sure to keep informed with the latest updates weekdays at 1 p.m. I'm Samantha Voon, and this video and podcast will be on our website, www.biztech.asia, and on social media. And it will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.